key domestic items on the macroeconomic front in the coming week will be mortgage approvals data from the Bank of England on Thursday the 29th of June, and then GfK consumer confidence on Friday the 30th. In April, the UK saw 64,465 mortgage approvals, to be precise. That represented the third consecutive month-on-month drop and the 11th straight year-on-year decline, presumably due to changes in stamp duty and new buy-to-let rules, both from a tax and bank lending perspective. This chart shows the data back to May 2015. Investors in house builders and related construction and consumer discretionary stocks may well be hoping for a pickup. The GfK consumer confidence reading for May improved to -5, bang on its 12-month average, although the reading is still nowhere near where it was 2 years ago. Bulls of retail, media and other discretionary spending names will also be hoping for improvement here too. In terms of companies, only 2 FTSE 100 firms are scheduled to say anything this week, and they are minor Rio Tinto, which hosts its annual general meeting on Tuesday the 27th, and support services stock Bunzl, due to provide a first half trading update on Wednesday the 28th. Of the two, I think Bunzl may be the one capable of causing the greater fuss. The company supplies the things that other firms need in order to do business, but not items they would sell to their customers. For example, Bunzl supplies disposable coffee cups to cafes, food wrap to supermarkets. It also supplements its own organic growth with bolt-on acquisitions. Nothing too big, nothing too transformational or risky, and then improves the performance of the purchases, leading, in theory, to increased profitability and cash flow, and all of the deals are self-funded. Gosh, I can hear you saying, sounds awfully boring, to which I would actually say yes and good, because investing isn't about excitement, it's about keeping your money as safe as you can, managing risk while you seek out returns, and Bunzl, over time, has provided good returns. As we can see here, Bunzl is one of just 26 FTSE 100 firms to have increased its dividend for each of the last 10 years consecutively. As a result, since June 2007, its shares are up by 234% compared to a 10% advance in the FTSE 100. And on a total return basis, capital gain plus dividends reinvested, Bunzl has offered a 331% gain compared to 60.5% for the FTSE 100. Nothing boring about that, I don't think. However, we must all accept the past is no guarantee for the future, and there are always questions to address. One right now is why the pace of acquisitions at Bunzl is accelerating. That may lead some to conclude it's getting harder for Bunzl to keep growing at the same pace, if only because it's just getting bigger. Other than that, Bunzl gets around 60% of its sales from America, so the latest round of dollar weakness may not be welcome, and as we can see, the shares have actually just come off the top a little bit. This makes the timing of this first half trading segment particularly interesting. So let's see what Chief Executive Frank van Zanten has to say. The key numbers to watch are, in order, sales growth. April's update revealed 18% sales growth, of which only 2% was organic, 3% from acquisitions and 14% from currency movements, with fewer trading days knocking off 1% on the timing of Easter. Look also for acquisitions. Bunzl bagged 5 deals in the first quarter at a total cost of £260 million, so keep an eye also on the balance sheet. Finally, operating margin, which has been stable around the 6.5% to 7% level for around the last decade or so. The only remaining question to answer is the valuation, and whether you think a forward price earnings ratio of 21.1 times for 2017 with a dividend yield of 1.7% represents value or not. The multiple is a premium to the market and the yield is a discount. Thank you for watching, and I look forward to seeing you next time.